We're here to talk about Silicon Valley real estate market and then the Greater Bay Area, week number 12. It's March 23rd, and I'm Richard Calhoun with Creekside Realty. My contact information is there for you. This is the first data slide. What this is doing is just showing you what we're going to be going over. We start off looking at simply the inventory compared to the 10-year median, the offers compared to the 10-year median, and the DUI compared to the 10-year median. The first two are just supply demand. The third one is starting to give you an indication of what the market is doing today compared to historically what it does. Then we look at current market trends, DUI or days on market, then ask price reductions. And then we finally look at the buyers overbidding, and that's a lagging indicator, which is why it's orange on the top. And then we come back and we look at appreciation and then the price range, not only the median, but the 10 and the 90%, and then the payment. Well, that's a recap of what we're going to do. We're going to start looking at 20 micro market areas that are listed here. Then we're going to look at Silicon Valley as a whole, so you can see the trends in the marketplace. Then we'll come back and look at the 3 counties. And then we'll finish up looking at the Greater Bay Area, which is 5 regions. And then we'll do a explanation of my data versus other people's data. And what this is showing you on a map, what the data actually is showing. What you're looking at here is the active inventory compared to the 10-year median. And you can see Santa Clara County is about 75% of what it typically is. So we're 25% down on inventory we normally are at. If you go up into San Mateo County, it's right about the normal level of inventories on both sides, so a little bit above, a little bit below. And then you go back to Alameda County, and it's sitting at 75% like Santa Clara County. In Alameda County, I don't have the individual micro market areas for the first 3 slides. And then we move on and we look at the number of offers, and it's the same concept. We're looking at offers compared to where they normally are. And Santa Clara County is probably at that same 75%. San Mateo County is maybe at 90% of where it typically is, and Alameda County is back at 75% of where it is. Now you look at the days on sold inventory compared to the 10-year median. So you're looking historically at what the days of unsold inventory and are simply comparing it to what you would expect it to be. And you can see Santa Clara County is somewhere around 90% of where you are. That means the market is about 10% faster than it typically is for this time of the year. You go up into San Mateo County, and you got some at 110%, which is slower. You got the San Mateo County coast at almost 150%, so 50% slower. But then you have Redwood City, which is sitting there at 88%. And then you come into Alameda County, and again, that's countywide data at 95%. Alameda County is basically right where you'd expect it to be. Santa Clara County is a little bit faster, and San Mateo County is a little bit on both sides, but probably a little bit slower than the other 2 counties. Now we're looking at days on sold inventory, and we're no longer comparing it to the 10-year median. We're simply looking at what the numbers are today, and then looking at my definition. Basically, from 1 to 6 weeks, I consider to be a seller's marketplace. From above 11 weeks, I consider to be a seller's marketplace. So no one's at a seller's marketplace, but the slowest areas, the ones that are taking the longest, are the expensive areas in San Mateo County, the San Mateo County coast, and then down into Hayward and Oakland. But you can see that the bulk of the Santa Clara County is probably at 2 weeks. Some of your outlying areas are at 3 and 4 weeks. In San Mateo County, it's probably just under 3 weeks, sort of for the whole county. And then in Alameda County, for the first time, we have data, and you can see the South Alameda County is basically right around 2.5 weeks, maybe something of that order. But then if you go up into Oakland and Hayward, you're approaching 60 days. So that's starting to slow down quite a bit. Now we're looking at days on market. And this is, instead of looking at median and average, which I maintain has significant issues with it, we're looking at the 75th percentile. This gets rid of the issues that I see with both the median and the average. And what it's saying is, how long does a long typical seller take to sell in the different micro market areas? And you can see Santa Clara County is right around 10 days. You go up into San Mateo County, and maybe it's approaching 3 weeks. The more affordable on the base side areas are probably back to 2 weeks, very similar to Santa Clara County. And then in Alameda County, you're basically just both sides of 2 weeks. So fairly fast marketplace. Basically it's saying any seller that's serious about selling their home in the Silicon Valley can pretty much sell their home after 2 weekends on the market. Now we're looking at the ask price reductions. So this is a measure sort of the seller's expectations compared to the reality. In Santa Clara County, you can see sellers are actually raising their price. Now, keep in mind that yes, some sellers raise their price, but this isn't usually they go on the market and they can't sell, and then therefore they raise the price and are successful in selling. These are things like a typographical error that I didn't catch, and I do catch quite a few, and that brings up the average, or it could be a offer that comes in way over asking price, and either the seller or the listing agent or together they decide they want to raise their asking price to more accurately reflect the sale price. And whether that makes a difference or not, because the appraiser clearly can see what you did, but raising prices is something that happens and can see that it's actually fairly common right now in Santa Clara County. In San Mateo County, they're pretty much doing price reductions, and you might think 3.5% isn't much of a price reduction. But what happens is the vast majority of the sellers have done their homework and they want to sell, so they come on the market at the price that it should sell at, and they don't have to do price reductions. And then you go into Alameda County, and they have both price reductions and price increases. And again, the color consistency here is red is favors the seller, blue favors the buyer, and the white is sort of a neutral marketplace. Now we're looking at the frequency of those reductions. So how common are those price reductions? And that's part of the reason why the price reductions are so small, is they're just not very common. And you can see in Santa Clara County, a good part of the county, somewhere around 5% of the sellers are reducing their price. That means 95% of the sellers are successful in selling their property without ever reducing their price. Yes, there are some areas that are doing more price reductions, like East, Central, and South San Jose at 14%. You go up into San Mateo County, and maybe that's closer to 7.5% average. And then in Alameda County, it's all over the place. It's 3% for a lot of the areas, but then you go up into Hayward and it's 8%. Oakland is at 17%. Berkeley, Alameda is at 7%. One of the reasons I look at the micro market areas is the media does a great job of doing a broad brush of what's happening in the Bay Area. Well, I maintain that there's a big difference between 18%, almost 20% of the sellers taking a price reduction, or in Oakland, 17% of the price reduction, sellers taking a price reductions, to an area like North San Mateo County, where only 4.5%, or Pleasanton at 3%, or Fremont at 2.8%, or Newark at 2.1%. Don't have a consistent marketplace, and that's why it's important to look at these micro market areas. Now we're flipping over and looking at what the magnitude of the overbidding is. And the drawback here is we have to wait for escrows to close. And that's about a 5-week, can be as short as 4 week, can be as long as 6 weeks. And when I say as long as, yes, there's going to be some escrows that are 10 weeks long. And that's one of the reasons I look at offers accepted instead of pending transactions. I don't want the transaction that causes problems for whatever reason and is in escrow for 10 weeks to influence the market for double the typical property that's only in the market for 5 weeks. And I don't want a cash transaction that's only in escrow for 1 week to only have 1/5 the impact of a normal loan transaction. So I simply look at the offer date, and I don't look at what's pending. And I know almost all my competitors or other people that are doing statistical analysis are looking at pendings, sales, and I think that's wrong. That's one of the reasons I got into this industry of doing statistical analysis of the marketplace that I work in. Anyway, the overbid magnitude, you can see 11% in the affordable areas of Santa Clara County, or the Cupertino Sunnyvale area, or even the Fremont area, and Berkeley, Alameda are sort of the high areas. Some of the low areas are actually price reductions in San Mateo County, just over 0.5% price reductions in both the expensive areas and the San Mateo County coast. Now you're looking at the frequency of overbidding. You can see the least frequent overbidding, again, is the expensive areas in the coast in San Mateo County. In Santa Clara County, 80% of the sellers are getting more than they're overbidding in what I call the heart of Silicon Valley, sort of the moderate price points. You come down into San Mateo County, and they're roughly 65% of the sellers are getting more than their asking price, and you go up into Alameda County, and it's probably 85% of the sellers are getting more than their asking price. So a pretty aggressive marketplace. Now we're looking at the appreciation since the last 9 months of 2015. So this is long-term appreciation. You can see that Newark and Union City right now are as close to the highest. The highest is Pleasanton. The close in Santa Clara County is Milpitas. Basically what you're seeing, and you can see it pretty well on the map, the close-in job center locations are having the lowest overall appreciation, and the outlying areas where people can now commute to work and don't have to do it as often, or they can commute in later in the day or earlier in the day and avoid some of that rush hour traffic, which is why the rush hour traffic is back and why it's spread out longer, is the people are going into work at 10 o'clock instead of at 7 o'clock in the morning, spreading out that rush hour traffic. And frankly, it's pretty bad in my opinion. I hate commuting, so that's a personal thing. Moving on to looking at the sold price. Instead of following the median price, which is the middle number, as most people do, I follow the cheapest 10 percentile and the most expensive 90 percentile in the area. So let's look at South County for an example. It's telling you that 80% of the homes are between $900,000 and $1.8 million, with the center point being about 1.3 million. You can see where the price point is. You can see where you're going to see the bulk of the homes. You go into some areas like San Mateo County Coast where the price range is more spread out and you go from 1.2 to 1.5. That's only about a 300,000 increase. But then from the median to the upper end, that's a $1.3 million price range. So you can see the first 40% is much more densely populated. The homes on the lower end tend to be very closely packed, where once you go above the median priced homes, they tend to be more spread out. It's just the bell-shaped pricing curve of Silicon Valley. So here's a recap of what we went over. And again, the first two columns by themselves don't tell you what the market conditions are. They tell you have a shortage of inventory and you have a shortage of offers. But now when you get over to DUI ratio, that's starting to tell you whether the market's faster than slower than normal. The next four columns tell you market conditions right now today, sort of the leading indicators. Then you have the two columns that require the sold price that lag behind by 5 weeks, 6 weeks, whatever number of weeks you want to say. And then you have data that isn't related to the market conditions, but where you've seen the most appreciation, what the price point is today, and what those monthly payments are, assuming an 80% loan and a 30-year fixed jumbo rate at the national average. Considering you've made it this far in my video, I'd appreciate it if you'd like my video by hitting the thumbs up on YouTube. Thanks. Now we're going away from micro market areas, and we're going to try to talk about what the Silicon Valley is doing. First group section was basically a snapshot in time of what the market's doing. Now you can see over time, and what you have is you have the inventory in the purple line down here. And so you're about 77.5% of the inventory that you normally are. Then you go up to look at the offers, and offers are about 80% of where you'd expect them to be. And since offers are higher than the normal active inventory, you expect a faster marketplace, which is what you have. And your days on sold inventory is only at 90% of what you would expect for this time of the year. This slide now is showing that lack of inventory. Right now, we only sold 1,600, and when I said sold, offers accepted, because that's the leading indicator. We only had 1,657 offers accepted in Silicon Valley for single-family homes. That's the lowest number in the past 10 years and the lowest number in 25 years. So in the last 25 years, the lowest number was almost 2,100. We're about 450 below that number, and that's only 80%. We're only selling 80% of our previous record low number of offers for the past 25 years. That has to be significant. If you look at the past 10 years, we're only selling 75% of that, and we're only 60% of the typical volume. So we're half of the volume that we normally are. That's half the number of loans, half the number of escrows, half the number of termite inspections, et cetera. So it's really hurting the industry, and people just aren't talking about that as much as I think they should be talking about it, because when you have a lack of activity, a lack of transactions, the market can change pretty quickly. There's no hint right now that it's changing, but that lack of transactions, that lack of volume allows it to change quickly. Now we're looking at the payment over time. The blue line is the cheapest 10%, the gray line is the typical, and the red line is the most expensive. And you can see the payments drop down over the end of the year holidays. That happens because the price drops down, and we can see that, and we'll see that in a little bit. So now what we're looking at is the seller's ask price reductions. We have two bold lines here. The green dotted line is up here. That's the current week. The blue dotted line down here, sort of in the center, is where we were a year ago. So you can see you're much better off, or you're having a much more favorable seller year this year than we did last year. Because last year you were down here, this year you're up here. You have fewer sellers taking fewer price reductions. So now we'll step through and you can see the improvement. This is where we, a year ago in time, coming up to present time, we start off at a month and then we go to weekly. So that's the bottom. And then pretty soon, right there, you start seeing the ramp up in the last about 7 weeks. And now we're starting to slow down. And so we're getting close to the peak for the year. And, that may sound weird, but the peak in the real estate marketplace comes earlier than most people think. Basically, the sold price is going to continue to increase because the rapid increase hasn't closed escrow yet, but those transactions are already in the bank, already in escrow. So the terms are already fixed. And again, you can just see the slowdown in that. And we'll go back. We'll work backwards. You can see how big those decreases are. See how big those ones is. So big, 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 smaller, 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 smaller. Therefore, that's why I'm saying we're already getting close to the peak for the year. Here we're moving over now and looking at the sold price. Now the sold price, remember, we have to wait for escrows to close. So there's a 5-6 week lag on here. And again, it's harder to see, but you can see the blue dashed line down here. That's where we were a year ago. We're up here on the green dash dotted line now. Clearly, we're doing better. And again, this is data that's going to be lagging the marketplace by 5 weeks. So I don't expect to see the market really peaking out yet. There we were a year ago. Now you can see going down last summer, last fall. You're getting close to the bottom. That's probably the bottom there. Now you can see we started to go up. Those are the big increases. And I would say we're still having big increases, knowing that the big increases on overbidding is smaller than the big increasing. It's just the way the graphs are, partially because on the overbidding, I'm looking at the whole distribution from 95% down to 5%. And on the overbidding, I think I'm only looking at maybe 17.5% of the marketplace because it's so stable. Moving on to looking at the active inventory for the Silicon Valley. So now we have Silicon Valley in that blender that we talked about, and we're comparing it to a hot marketplace, the thin red line on all the data. The typical line, the gray line, is where you'd expect the market to be for each metric, and the blue line is where you'd expect the market to be in a cold marketplace. The purple is the actual data, so you can see we're basically approaching the end of the first quarter, which is a solid gray line vertical. And then the purple is a little bit to the left of that, so because we're not quite there at the first quarter, beginning of second quarter. But you can see that we have a lack of inventory. Yes, in the hottest years, you would have had less inventory. You'd be down here somewhere around 1350, something like that. And right now, maybe you're at 1525. So we do have more inventory than a hot marketplace, but we're still pretty hot. Here, we now take that gray line and stretch it out and make it straight. And you can see that we're about 77% of the inventory you'd expect to have. So we have a shortage of inventory. Now we're looking at the number of offers accepted in the past 5 weeks. So this, again, is not pending transactions, which most people follow. A pending transaction is a transaction that's in escrow. And yes, that's useful data, but I think it gets skewed. And if you and as I've already explained, an escrow that's in for 10 weeks impacts the data for twice as long as an escrow that's only in for 5 weeks, and an escrow that's in for 1 week only does 20%. I would average all that out and say every transaction, whether it be an escrow for 5 or 1 week or 10 weeks, impacts my data for 5 weeks. And so what you're seeing here is a lot. We're actually sort of below the blue line, although it looks like we just got right to it. So we basically have had lower number of offers than you would expect, even in a cool marketplace. Right now, you're right about the least number you'd expect. And you can see you're 75% because you're two-thirds, you're 2,000 transactions instead of 3,000 in a hot marketplace. You'd expect it to be somewhere around 2,600. So we're off by about 30% of where you'd expect the market to be. Now we're looking at that same data, but we took that curvy gray line, which is the seasonal fluctuation, and pulled that out straight and looked at where we are compared to the season. And you can see you're basically right about 80% of the level of offers that you would expect. Moving on to days of unsold inventory, you're towards the hot side of the marketplace. You're less time on the marketplace, than the gray line, but you're nowhere near the red line. So we've had years that are quite a bit hotter. You're actually pretty close to the gray line, but a little bit on the seller side, favoring the seller a little bit from typical. And for the last 10 years, we've always been in a seller's marketplace. So that's something to keep in mind. Even if we're where we typically are, that doesn't mean the buyers can go out and negotiate because we've been in a seller's market for so long. Same concept now. We take that gray seasonal line, pull it out straight, and you can see that the days of unsold inventory is 90%. So we're 10% faster than we typically are for this time of the year. And that's based on the last 10 years. Here we're looking at the number of days on the market for the 75th percentile. And you can see even here on the 75th percentile, see these step functions? That's what's wrong with the median. And you can see it's impacting my data already. So maybe I should only be looking at the 65th percentile to get it a little bit smoother, but this is these step functions prevent you from seeing what's in the market. When you have a large number, you can see the data is much better behaved on the gray line or the blue line, but our data now, the purple line, has got to the point where we have that step function, but you can come back and see that happens anytime you get down below about 15 days of unsold inventory. But this is this long typical seller for all of Silicon Valley, all three counties, is selling in just over 2 weeks at 15 days. Now we're looking at that compared to normal. If it was normal, it'd be up here on the gray line. We're only at about 75% of that. That means the sellers are selling in 25% faster time on the marketplace. Now we're looking at ask price reductions. So this is looking at where the seller's expectations were when they came in the marketplace. And notice we did, for a very short period of time, exceed 100%. But even in a hot marketplace, sellers take price reductions. Now, granted, these are very small because this is sellers on this line, horizontal gray line here, is sellers only taking 1% price reduction. So here's 0.25%. The thin gray line is a quarter, a half. So right now we're basically taking somewhere just over 0.25% price reduction. But again, that's not because people are taking 0.25% off their ask price. It's because the vast majority of the sellers take no price reduction whatsoever. Same concept, pull out the gray line, nice straight line. You can see we're pretty darn close to the typical. So your price reductions right now are about 0.1%. Here's the largest price reductions. So here I'm ignoring 90% of the sellers, and I'm just looking at the sellers that are taking the biggest 10% price reduction. So you can see in a hot marketplace, those sellers do take a 5% price reduction or more, and maybe you come down here and even say they're taking close to a 9% price reduction in a typical market. Well, the typical is the gray line. So it's even more than 10% price reduction for the 10% of the sellers that are taking the biggest price reduction. Right now, we're on the purple line, and they're taking about 90.7%. So they're taking a 9.3% price reduction. That's only 10% of the sellers, and those sellers are taking the biggest price reductions. And that's what happens. That's why the metric is so tight, is somewhere close to 90% of your sellers are doing no price reduction whatsoever. And now what you're looking at is the same data pulled out to normal. So the gray line is horizontal. You can see that sellers are taking, 25, 30% more price reductions than they typically do. Now, granted, that sounds like a lot, but it really isn't. This is the frequency of ask price reduction. So you can see the frequency is right where you'd expect it to be. And if I'm understanding my graph correctly, only somewhere around 8% of the sellers are doing price reductions. Here you can see a little bit more than the sellers are taking price reductions than normal. So 8% at this time of the year is more than normal, but still pretty close to normal. And now we're looking at the magnitude of overbidding. So now we're lagging behind by that 5-week escrow period of time. But you can see the overbidding right now is coming in at almost 8%. I guess it's about 7.5%, 7.75% above the seller's asking price. And that includes those sellers, those 10% of the sellers that are probably taking a price reduction. And it, whatever number of sellers take below asking price, there's sellers that they're taking higher. So this is just the average. It includes all transactions, not just those above. Here's pulling the gray line out, making it horizontal. And you can see that sellers are getting 2% above the normal price reduction for this time of the year. Here's the frequency. So you can see we're slightly above, but darn close to the gray line, with somewhere close to 70% of the, just over 70% of the sellers getting more than their asking price. So that means only 30% of the sellers are taking a price reduction or getting their asking price, because you have to be over the asking price to be included in the 70%. There's where we are compared to normal. So we're a little bit above typical. Here's long-term appreciation. The blue angled line is sort of where I say is typical appreciation. And then you can see the dip down every year for the end of the year holidays. When the market was absolutely on fire, you had a flat plateau, but you can see, and you had a U here, but basically the V is very consistent. I believe that's the social makeup of the real estate market. Real estate as purchases is a time-consuming event. Social activities get in the way of it. So when sellers are busy with holidays, they don't go do real estate. And so the types of properties, the areas where the properties are selling all shifts. And that's what this bulk of this price decline is. It's not market value. If you stop selling homes in expensive areas and start selling more homes in the more affordable areas, because those are people that don't have families yet, or whatever the reason is, families that can't take travel, so they go look at houses, those are the people that buy. That lowers the median price. Here now we're moving on and looking at the 3 counties. We have Santa Clara County in the blue, Alameda County in the gray, and San Mateo County in the orange. This is simply looking at the number of active listings available. This is looking at the number of offers accepted. You can see that Santa Clara County is outperforming Alameda County right now. You can see the rapid increase that we have every year, and we're definitely having it this year. And this is the days of unsold inventory. You can see Santa Clara County is the fastest. San Mateo County and Alameda are very close together at 30 days, which is still very quick. Now we're looking at 75th percentile. You can say same order as days on market, with Santa Clara County being the fastest and Alameda County and San Mateo County being very similar together. We're looking at the price reductions. San Mateo County has the most price reductions. Currently, Santa Clara County has the least. And basically at 100%, they're not doing any price reductions. And Alameda County is close behind at about 99.7%, so 0.3% of the sellers. Now we're looking at the price reduction frequency. Santa Clara County has, what is that, 6.5% of sellers doing a price reduction. San Mateo County is, it looks like it's under 9%, and Alameda County is just over 9%. This is overbid magnitude. Alameda County. So even though Alameda County wasn't doing as well as Santa Clara in the previous slides on overbidding, Alameda County has the most overbidding. Santa Clara County second at 8%, and San Mateo County the least at 5% overbid on average. This is the frequency of overbidding. Alameda County again on top, Santa Clara and San Mateo. This is looking at the appreciation. Alameda County, look how rapidly that's shot up. So Alameda County is above where they were at any time last year, and then Santa Clara County is still below where they were, and San Mateo County is right about where they were. And all 3 counties are below where they were in the peak of 2022. I've added in horizontal lines so you can see a little bit better. San Mateo County, you can see the peak up here is right here, sort of in this top of the graph where the cursor is, you can see the prices were higher in 2022. Santa Clara County, the bandwidth and the height isn't as much. And Alameda County probably has the least, but very similar to Santa Clara County. The big difference for Alameda County is it's above where it was last year by quite a bit, where Santa Clara County is going right through the middle. So Alameda County has had the most appreciation on this spring already. Here's the same information on regular paper. The previous was on log paper. This is the payment for the different counties for people to see what they are. So the most expensive county is San Mateo, Santa Clara, and Alameda. So affordability, you go out into Alameda County. Here's the data for each of the three counties, whether you start off in Santa Clara, San Mateo, or Alameda County, or if you want Silicon Valley as a whole. Now we're leaving Silicon Valley and we're going to start talking about the Greater Bay Area. This is 13 counties and in 5 regions. One of those 5 regions is Silicon Valley. We're starting off with the numbers so you can look quickly at whatever metric you find most useful for what it is you're trying to figure out. Now you're looking at the active inventory for the 5 regions. You can see that San Mateo County and Central Coast are right together. They're similar in size. You can see North Bay has the most, followed by Central Valley, followed by Silicon Valley. Fairly close together. Silicon Valley typically has less inventory. North Bay and Central Valley typically have the most inventory, and they do now, but you can see how far down they are from where they typically are. You know, I don't know what number you want to pick for first quarter, but it's going to be somewhere up here around 4,700, and now they're down under 2,000, so they have half the inventory that they typically do. This is looking at the offers accepted, the same concept. Silicon Valley has had the most offers at 2,000. North Bay and Central Valley are very close together at about 1,600, and Central Coast and cities are down around 300 and 400. Days on sold inventory, Silicon Valley is the fastest, Central Coast is the slowest. Days on market, same order, Silicon Valley the fastest, Central Coast the slowest. But you know, even if you look at 75% of the sellers taking almost 2 months to sell their property, that's fast compared to most areas in the country, I would wager. Here's looking at your price reductions. Here we have Central Coast doing the most price reduction because here 100% is no price reductions whatsoever. The further down you are on the graph, the bigger the price reductions. Cities is number 2, North Bay is number 3, Central Valley is number 4, and doing the least price reductions is Silicon Valley. This is looking at the frequency of price reductions. You can see Silicon Valley is doing the least number of price reductions, followed by the cities, that's San Francisco and Marin. Then you have North Bay, and I actually think Central Coast is outdoing the Central Valley, but they're right on top of one another. I think the yellow is a little bit higher. It's hard to read when they get on top of one another. Here now we're looking at the overbidding. So overbidding lags behind by 5 weeks. So this is where the market was 5 weeks ago. The most overbidding in Silicon Valley cities is next. Then you drop way down to North Bay, and I mean 8% down to 2%. That's a difference right there. And this is the magnitude of overbidding. Then you have the Central Valley and the Central Coast real close together at somewhere around 0.5% to 0.75% of overbidding. This is the frequency of overbidding. Silicon Valley has the most overbidding for common at just over, what would that be, 72%. The cities is coming in at right at 60%. North Bay is coming in at 52%. Central Valley is coming in at 48%. And the Central Coast is coming in at about 37% of the sellers are getting more than their asking price. Here's the long-term appreciation. Central Valley and Silicon Valley are right on top of one another. The purple is overriding the yellow, so you really can't tell where it is. But I think the yellow may be right about there. So Silicon Valley is outperforming right now, but they are pretty close together. North Bay is next at almost 70% appreciation, and this is since the last 9 months of 2015. Central Coast is down around 58, and doing the least well is San Francisco and the cities. And you can really see that prior to the pandemic, they really were doing very similar. Silicon Valley had a few standout years, but came back. The pandemic was announced. and almost immediately the cities bubbled down to the least amount of appreciation. People always said they liked to live in San Francisco, but when they had the option of working remotely and things, they fled the city, and that hit appreciation. Here's the median sold price for the different areas. You can see that the cities is outperforming Silicon Valley a little bit as the most expensive region. Then you have the Central Coast, then you have the North Bay, and the most affordable area is the Central Valley, San Joaquin, and Sacramento counties. Then you look at the monthly payments, they're going to be in the same order as the pay prices because it's just a formula I go through based on PITI 80% loan. We've been talking about week number 12 of Silicon Valley. You can get the archives by typing in the blue YouTube link, or if you want to do shorter typing, you can type in what I call my green root URL. If you add in 2024 to the end of the green root URL, you get to live presentation Saturday morning. If you add in H, the year 2024, the month 03, the day 23, you get today's handout. It is posted. I did find a couple quick errors from when I posted the handout to the slide. So where there's a difference, and it's mostly on the first slide where I'm showing all the colors of the different micro market areas. Two of them weren't shrunk down correctly, so I corrected that data. And then if you want any specific episode, you type in the month, year, date code after the URL. I'm Richard Calhoun with Creekside Realty. My contact information, email address, and phone number. You can text if you prefer. I've been working with buyers or sellers in Silicon Valley since 1981. Happy to work with you. See if there's anybody that's got any questions. I'm not seeing any unmuted mics. The data being presented here is the most extensive local Silicon Valley-based real estate data and most current available. I look at data that most people do not look at. I don't look at median or average days on market. Instead, I look at the 75th percentile of time of successful sellers. The reason that number is so beneficial is it tells only the sellers that price their home appropriately to sell. How long is it taking the long typical seller to sell? Not the seller that underprices it and has a price war that sells the first week, but those that price it a little bit on the high side, potentially, buyers have to come in, kick the tires, make an offer. Basically, 75% of the sellers are selling quicker than that, 25% are taking longer than that. I also look at the magnitude of the seller price reductions. How big are the price reductions and how frequent are those price reductions in order for the seller to attract the buyer to write the offer? I also look at the frequency and magnitude of overbidding, not just the average. I look at the whole distribution, everywhere from the 5th percentile to the 95th percentile. So you see where 90% of the homes are. I leave out the outlying 5% because they're statistical fluctuations, they're input errors, and they skew the data. So I look at 90% of the marketplace to get a better feeling what the market's doing. I look at micro markets. I've selected 20 micro markets in Silicon Valley. A couple of them are very small, like Foster City, Redwood Shores, but a lot of them are large enough that they give you meaningful statistical data on what's happening in an area. Yes, that doesn't tell you what the value you should offer on a particular home is, but it gives you an idea of what the trends are, what the annual trend is. Also, I don't look at pending data. Pending data is biased based on the transactions that take the longest to close. The more difficult transactions impact the data for a longer period of time than the cash transactions that close in a week. By looking at offers accepted, every transaction counts the same, whether you close in a week or close in 10 weeks. It makes no difference when you look at simply the number of offers that are being accepted. I also look at weekly data, and the reason I look at weekly data is the real estate market is heavily dependent on weekend activity. Buyers go out on the weekend, properties become available for showing on the weekend, offers are then looked at during the following week. So there's a huge weekly cycle. That weekly cycle gets impacted by holidays. So if we have Valentine's Day and Mother's Day that positively impacts the real estate marketplace, or pretty much any other holiday negatively impacting the real estate market, that's important to understand. So instead of looking at monthly data, which even has a varying number of days of the week in it from one month to another, by looking at weekly data, I normalize all that. I also look at a real estate calendar year. My real estate calendar year starts on March 1st. and then I march forward 7 days at a time until you get to February 21st. And then instead of marching forward 7 days to February 28th, I jump 8 days back to March 1st. So you're comparing the same date of the year to the same date of the year. The drawback of doing that is that date of the year does vary. One year it'd be a Monday, then it'd be a Tuesday, then it'd be a Wednesday. But the huge advantage is when you have leap year, you simply jump forward to 9 days and get back to March 1st instead of jumping forward 7 or 8 days. So your data is more consistent. There is a little bit of a drawback, but it's far better than comparing January with 31 days. You don't have an even number of weeks and weekends in there. The number of weekdays and weekends vary from year to year. So that's a huge impact on the data. So I made a lot of decisions to make the data more representative of what the market's actually doing. I also look at simply the components, the active listings. I compare that number of active listings currently to the 10-year median. I look at the number of offers. I compare that to the 10-year median. I do the same with days of unsold inventory. In fact, I was the one that introduced days of unsold inventory, and that's the speed of the marketplace. And I simply look at the raw count. Basically, roughly speaking, anything that sells with a days of unsold inventory of less than 6 weeks is a strong seller's marketplace. Over 11 weeks tends to be a strong buyer's marketplace. So you can look at each one of those metrics individually. On median sold price, which almost everybody follows and reports, I also report the 10 percentile price and the 90 percentile price. That gives you a huge advantage because now that price points for each micro market is sandwiched. You know the lowest price point that you'd expect and the highest price point you can expect. I also look at the appreciation, both shorter term since the pandemic in 2020, but I also look longer term since the last 3 quarters of 2015. I was hoping to do a full calendar year, but I wanted a period of time when prices were relatively stable. And unfortunately, they weren't very stable in the first part of 2015. So that was the most stable price point I could find. So you can see whether buying in Alameda County or in San Mateo County has been a better investment over the long term. It turns out that because of the pandemic, it's further away from the job center, but that's, it's going to be different from time to time, and past performance doesn't predict future performance, but it's still interesting to look at. I also present the data visually on maps so you can see the trends. You can see where the market is hot. You can see cool spots. You can really see it visually and you get a better feel for what's going on. Yes, when you get down to making an offer on any particular home, you want to look at a detailed CMA, but the micro market data gives you a better idea of what's going on. A lot of people report data by zip codes, but the problem with zip codes are they could be in different school districts. They could be too small and you have statistical fluctuation. In fact, even my smallest micro market that I can think of has multiple zip codes in it to try to stabilize the data. And right now we're having record low number of transactions, which makes the data more unstable because you want a large group. And that was sort of the mindset behind the micro markets, is trying to get a largest group that you could of geographically close and similar type properties to define a larger market so that you get better statistical meaningful data. Anyway, that's a quick recap of what I typically am trying to present on this data. I'm open for any suggestions on the people out there, the viewers, on what I should do slightly different, what I could do to improve the data, what metric am I not following, because the sum of all my viewers is greater than my knowledge, and I learn from you guys all the time, so I appreciate that. We've been talking about Silicon Valley real estate market geographically and graphically in the here in Silicon Valley, plus the Greater Bay Area, which is 13 counties and 5 regions. This has been week number 10. You can look at any archive on the YouTube by typing in the blue YouTube URL, or you can type in the shorter green tiny URL. I call the green one my root URL. If you add 2024 to that Saturday morning at 9 a.m., you get to the live presentation. And you can ask questions as we present or at the end of the presentation. And if you want a handout, it's the green root URL plus H 2024-0309 for the current year month date of the presentation, My data is now through midnight on Thursday because of the calendar year. And if you want a specific episode, you'd start off with the green root URL and add in 2024 0309 or whatever episode it is you want. I'm Richard Calhoun with Creekside Realty. Been working here in Silicon Valley since 1981. My email address and phone number is on every slide. Look forward to helping anybody with any questions. And thanks for joining me, because I don't see anyone with unmuted mic. Thanks. Bye for now.